Following the market's extreme bout of volatility, the trade war could soon be coming to an end, according to the Commerce Secretary Lutnick. U.S. Commerce Secretary Lutnick says Trump may roll back Canada and Mexico tariffs tomorrow, giving a very specific date of tomorrow. Now, he goes on to say that we're not going to pause tariffs again. There's not going to be a delay in tariffs, but it'll probably be somewhere in the middle. If we're looking at 25%, this could be something like 15%, with probably some compromise from Mexico and Canada. Now, it's actually very interesting about the news that is coming out right now out of China. They're having an economic meeting, per se. It says China plans 1.3 trillion won of ultra-long special sovereign bonds, which perhaps maybe that means China and other countries buying more US bonds. That could be a concession to lower the tariffs, and something we should be on the lookout for as a potential possibility. Now, Donald Trump is going to be giving the State of the Union address in front of Congress here in the next short moments, in about an hour or so, and there's going to be many headlines that come out from that, and I expect the markets are going to be pretty volatile as well tomorrow. But we do have some major economic data, and unfortunately, the tariff situation is really only half of what's affecting markets right now. And I would categorize this market as one part tariffs, one part growth worry, or growth concern, or growth scare, whatever words you want to use. Same thing. Well, the tariff picture could be clearing up a bit here soon, but that doesn't give us any hope or clarity, if you will, probably a better word's clarity, on the state of the economy. In recent weeks, it looks like the economy is, well, really teetering on the edge of a larger slowdown. We've seen personal spending, retail sales, durable goods orders. We've seen basically everything as far as economic data come in worse than expected in the last couple of weeks. And this has started a growth scare. Now, what's interesting about this growth scare is nobody's really buying into it too much. If you listen to hedge fund managers, if you watch any CNBC or really any financial media, nobody's really concerned about a real possibility of a recession. And unfortunately, that is in the cards with the kind of data that we're getting as of recently. The Atlanta Fed GDP Now tracker is tracking negative 2.8% GDP. I get it. It takes the latest data point and extrapolates that for a full quarter. So basically, if the data keeps coming in this bad, we're going to have like a severe recession. That's probably not going to happen. GDP is probably not going to be negative 2.8%. It's probably going to come back up. But is it going to be positive? How bad is it going to be? I would argue it's going to be worse than Wall Street is currently expecting, around 2% GDP growth this year. Now, if the data continues to weaken from here, we are going to be in a big problem. And tomorrow morning, we get some very important data that will be coming out. Now, the data that we get tomorrow is your services data. Now, services is a majority of the economy. So you really can't have weaknesses in services. Okay, the last 2 years or so now, manufacturing has been in a recession, really because the Fed and manufacturing is a capital-intensive business. Okay, it's been a lot of layoffs in manufacturing. Well, 50 years ago, most of the economy was manufacturing, like Paul Volcker era. That's why we had a severe recession, because of what the Fed did and manufacturing being a large portion of this economy. That's not the case anymore. The Fed really doesn't affect services. What affects services is really consumer confidence, okay? If you do not know, or if you're not confident in the fact that you're going to have a job next week, you're probably not going to go out and spend a bunch of money. You're probably going to reduce your phone bill, which counts as services. You're probably not going to go out to eat at restaurants all too often. You're probably going to start saving a lot of money. Recessions are confidence issues If you stop spending, companies stop producing as much, idle factories lead to layoffs, and well, yeah, it's kind of a self-fulfilling prophecy at that point. And I see a lot of concern with what the government is doing. Now, obviously, this is, again, I've described this as like an alcoholic, right? We have been alcoholics on stimulus, on government spending. We've loved it in the past couple of years, and it is on paper boosted the economy. Okay, well, they're retracting that. Even news here that came out at about 6 p.m. today, the IRS is planning to cut as much as half of its 90,000 person workforce. Like, this is creating some real uncertainties in anyone with a government job. Okay, that's not exactly great. Now, of course, you need to cut down on government. You need to give the investment back to the private sector. Private sector is really what fuels real growth in the economy, okay? The government just prints money. It puts us in a bad budget situation. It raises long duration bond yields, and that's why the Fed cut rates 1%. And bond yields, 10-year Treasury yields went up 1%, okay? But some of the issue is retracting all of that government spending, cutting off the spigot of free money is like cutting off alcohol from an alcoholic going through withdrawal. The withdrawal comes and it's bad, okay, for a period in time. That's kind of the stage that I think we could be heading into. Now, on the other side of that, it's much more prosperous, a much more strong economy, if you will. But between now and then, there could be some weakness. So, trade war could soon be coming to an end. I think there's going to be some concessions, one of which could be these companies maybe purchasing long duration treasuries to help bring down 10-year Treasury yields. It seems like the main focus of this administration is not the stock market like Trump 1.0, it's the bond market. They want to make buying a home affordable again. They want to make getting an auto loan affordable again. And I think that's a great thing for the economy. Okay, just imagine how much wealth would be unlocked, how much essentially private sector stimulus there would be if mortgage rates went back to 5 or 4%. Okay, people have massive amounts of equity in their homes. What if real estate started to actually sell again and people could sell their homes? Right now, there's virtually no home selling. It's the lowest amount of transactions in the history of America. That's crazy considering we've lived through a housing recession. There was more houses selling in 08, 09 than there is today. That's because it's unaffordable. And I think that's one upshot to this year. If the government can effectively bring down treasury yields, start moving real estate, people are going to sell their homes and wake up with $200,000 in the bank with a new home that they can afford, and they're going to go out, they're going to spend that money, and that's going to be great for corporate America. So I wouldn't be surprised if concession from Canada, Mexico, and China could be the purchasing of U.S. treasuries. We did get, again, that news out that China is setting up basically 1.3 trillion yuan of ultra-long special sovereign bonds. I don't know if that is U.S. or whose bonds they're going to be buying, but it wouldn't surprise me if that's a deal Trump has kind of struck with China, and similar one with Mexico and Canada. Now, again, coming out tomorrow morning, we are going to get the ISM Services PMIs. Now, I want to share with you the report from the last Services PMI report and why I'm really not confident about tomorrow's report. It says here, and again, this is the previous report, okay? The ISM Services PMI for the U.S. declined to 52.8 in January 2025 from a downwardly revised 54 in December of 2024 and well below forecast of 54.3. So again, it was worse than expected. Alongside basically all economic data reports we've gotten recently, they've all really come in worse than expected. It says the reading pointed to a slower expansion in the services sector due to smaller increases in business activity, coming in at 54.5 versus 58. I see no reason why we would see expanding business activity at this point. It may actually be negative, and that's going to bring up more of that growth concern coming tomorrow. And new orders that also plummeted, falling from 54.4 down to 51.3. I don't see any reason why that's going to be any better either. It says also inventories were in contraction territory for the third month in a row. Inventories probably are going to improve a little bit because there's a lot of front running of tariffs. So if you're trying to get around the tariffs, like Ford, GM, for an example, they are ordering as much as they possibly can or have been in the weeks leading up to the tariffs going back into effect because they want to have as much time as possible, as much inventory as possible to come up with solutions around these tariffs. Now, on the other hand, employment came in at 52.3 versus 51.3. So it was actually better than expected. I don't see that as continuing though, but hey, I could be wrong. And new export orders, 52 versus 50.1, increased faster and price pressures eased from 64.4 down to 60.4. They say, quote, poor weather conditions were highlighted by many respondents as impacting business levels and production. Like last month, many panelists also mentioned preparations or concerns related to potential U.S. government tariff actions. However, there was little mention of current business impacts as a result. So again, last month's report really didn't look great. I have no reason to expect that it's going to look good coming tomorrow morning. And with the market so concerned about a growth scare right now, the expectations are pretty high. Okay, so tomorrow you're expecting 52.6 as your headline number. Last month's number was 52.8. So you're expecting a slight decline. You could see a massive decline tomorrow morning. And that's going to put pressure on stocks. Now you're also going to get factory orders month over month. Last month was negative 0.9%. You're expecting 1.6%. Again, I think that's way too optimistic. You will also get the Fed Beige Book coming out tomorrow morning. Now, obviously, later on throughout this week, you will get initial jobless claims on Thursday, exports, imports, and the balance of trade, as well as the challenger job cuts. Now, I do think tomorrow morning you also get, the ADP employment change. You're expecting 140,000 in tomorrow's report. Now, the last report that we had says here, let's see, hiring momentum in Q4 carried into January with some exceptions, including manufacturing. Quote, we had a strong start to 2025, but it masks a dichotomy in the labor market. Consumer-facing industries drove hiring, while job growth was weaker in business services and production, the chief economist at the ADP said. The service-producing sector added 190,000 jobs, led by trade, transportation, utilities, 56,000, leisure, hospitality at 54,000, education, health services at 20,000, information at 18,000, professional and business services at 14,000, and financial activities at 13,000. The goods producing sector lost 6,000 jobs due to manufacturing, 13,000 of which offset job gains in natural resources and mining. Nothing here on government jobs. Yeah, this is the ADP, so you're not going to get government jobs. This is a private sector report. And again, I think we're kind of optimistically set up for tomorrow, expecting the ADP number to come in, where is it? Right here at about 140,000. I think that's pretty optimistic, and we could see a downward surprise on both of these data sets tomorrow, which again is not going to be good for markets because let's face it, are we priced for a recession? No. Should we be priced for a recession? No. Okay, not at this point. I don't think there's enough clear-cut proof that we're heading towards a recession. Should we be prepared for like a really slow growth year? Probably. We're not. Okay. Fact of the matter is you're only down 5% from all-time highs, and we've rallied massively from, even where we were in 2021 and even more so in 2022. Like there's a lot of gains in this market. And as the economy weakens, I think you need to start reflecting some of that. So short term, could you bounce? If Trump has good things to say tonight, or, trade war ends or something, sure. But I don't think we're going to get a sustained market rally into new all-time highs and a breakout from there until you get the economy that starts to look better or starts to look like it's stabilizing to give us more clarity. And each data report that we get that suggests consumers weakening, economies weakening further, you're going to get closer to pricing in some of those recession concerns. And while markets fell 27% in 2022 because of recession concerns, now I don't necessarily think that's going to happen this time around, but I am expecting to some degree the same kind of dynamic in markets that we had in 2022. I think it's going to be a lot of ups and downs, a lot of very choppy trading. Right? You're going to get big drops and big, rises. Another big drop, another big rise. And you're going to kind of trade sideways to down for longer than people think. And I think that's the danger right now, going short-term call options or going in with a lot of margin here. You could bounce for a little bit, but you will very likely come back down again. And I don't know where the ultimate bottom is going to be, Could it be 490? Could it be 520 on the SPY? Not sure. Okay. But I do think you continue to fall further from here. And maybe 10, 15% from all-time highs could be appropriate, which would put you down to about 550 to as far down as 520. Could make sense. But I think there is that risk that the data continues to weaken and get worse, and we have to all of a sudden start pricing in recession risk, in which this 5% drawdown has not priced in recession risk. And I think that's the biggest threat to markets. It's not tariffs necessarily at this point. It's confidence. It is uncertainty that can lead to consumers pulling back, that can lead to businesses that stop investing, at the very least stop hiring. And that could be a problem for the economy. At the same time, the Fed's kind of throwing their hands up in the air and saying, I don't know what we're going to do. We're just going to wait and see what happens at a time in which the economy could be weakening materially. Add that together, I don't think that's a great outlook for stocks. Maybe I'm wrong. Let me know what you guys think down below in the comment section. Keep in mind, not a financial advisor, not a financial planner, somewhat of a fortune teller over here trying to predict what is going to happen next in markets. Always a very difficult thing to do, and I will likely be wrong. But, in the off chance that I'm not, and the economy continues to weaken, well, you heard this video and you heard it first here. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.